Is the chase for yield over? Yields are rising globally, but does this mean the great search for yield could be coming to an end? If so, what unraveling should we expect in other yield assets such as REITs and utilities? In case you're really confused with how yields, bond prices, the Fed, Treasuries, etc. all work together, don't worry, we dive into that also. Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain and I'm your host. At Investor in the Family Radio, we believe that every dollar and minute we spend is an investment in something, and together, we want to make the best investments that we can, so thank you so much for joining us. Remember, our goal here is to help you learn to invest financially and in all of life. You can always find more at investorinthefamily.com and subscribe to the podcast at iTunes, Stitcher, or the Google Play Store. As always, if you would like detailed show notes from today's show, you can simply text the word family notes. That's one word, family notes, the number 44222, or visit investorinthefamily.com and sign up there. We'll be sure to get you taken care of. And you can get all the detailed show notes from today's episode, as well as all of the sign up bonuses I've ever given away. Do you like shopping for insurance? Of course you don't. It can be a terrible experience, especially when it comes to life insurance. If you have loved ones that you want to take care of financially after you're gone, then you may want to consider term life insurance, and Policy Genius is the easiest way to get insurance, period. At Policy Genius, you can figure out what you need, compare the top policies, get covered, and save. If you want to save on term life insurance, go to investorinthefamily.com/policygenius. That's investorinthefamily.com/policygenius for access created specifically for Investor in the Family listeners. I do get a small commission if you use my link, which costs you nothing. It's a win-win. Visit investorinthefamily.com/policygenius for more info and have the most enjoyable insurance shopping experience you've ever had. And hope you enjoyed today's interview with Ian Bezek. Well, hey, Ian, welcome back to the show.
It's great to be back. Always a pleasure.
Yeah, well, thanks. It was always great to have you as well. And today, I want to talk about a recent article you wrote called "Is the Chase for Yield Over?" where you kind of looked at a global sell-off happening in bonds. And this was about a week ago, mid-October 2016, and we're late October 2016 right now. And I'd love to hear, if you don't mind, just sharing the brief thesis and idea behind that article, and then we'll discuss it for a little bit.
Sure. The thesis for that article is that yields in many countries, not just the U.S., appear to have hit a low point in June or July of this year. And since then, we've seen a fairly strong rebound in yields, not just in the U.S., but also in Germany, in Japan, and in some emerging markets now. And at the same time, we've seen a lot of sectors that are related to yield, like utilities, like real estate investment trusts. Those have really seen the biggest sell-offs that we've seen in many quarters for those sorts of stocks. And the type of money you're seeing moving out of these, both bonds and these kind of yield-driven stocks, seems to be such a large amount that it indicates that a lot of institutions are starting to think, maybe the trend has changed. And so it's worth considering as the move toward kind of infinitely lower interest rates finally ended.
So the idea is that as with the assumption of interest rates increasing, and then maybe whether that factors in the Fed in December, obviously I'm sure they're anticipating that, as interest rates on bonds is increasing, people don't need to find yield elsewhere, and they can come back to what seems like the safer place to find yield. Is that basically the idea?
Yes. In that article, if I remember correctly, I used the phrase yield tourists for people that would normally own bonds, retired investors, but also institutions such as pensions that need to get a guaranteed return. So they need to make 5% a year. And when they can't get 5% a year from treasuries of any major country, and they can't get it from even municipal bonds now, they're starting to look at they might look at an AT&T and say, hey, this yields 5%. It's fairly safe. This is better than a bond. But the moment they can buy a risk-free bond that yields the same thing, they're going to sell the stock and go back to what they're comfortable with.
So what do you think is behind this? Why do you think yields globally seem to be rising? And I assume this is yields like on a country level and even like local municipalities and otherwise, or is it mostly just on a country level?
It starts at the country level, and then it filters into other bonds because bonds are priced off of the spread versus the risk-free asset. Like when a state wants to borrow money, people will say, we'll charge you this rate over the treasury bond. So as the treasury bond goes up, then everything else goes up.
Yeah, so the treasury bond is the basis for yields on all bonds.
Correct.
Right, great.
As for why the move has changed direction, I think there's two main factors. one, you're seeing more optimism globally. Troubles in China really have people aren't paying attention to them anymore. The price of oil is going back up. A lot of countries that had been struggling, like Brazil, like Russia, are suddenly looking better. And so people are saying maybe we don't need to hunker down in, Swiss bonds that pay negative interest rates. Maybe we can go exploring and try to actually make money again rather than staying in this defensive posture. And I think, oh, sorry.
No, you go ahead.
I was going to say, I think the second factor is that you're seeing some negative effects from negative interest rates starting to pile up, and particularly in Europe, where rates have been lower for longer. You look at banks like Deutsche Bank that don't seem to have a business model now. They simply can't make enough money to cover their overhead, and so that's going to require bailouts. You have these pension funds that can't meet their obligations to their retirees. The central banks are starting to look at this and say, we can't really stay in this position forever. And so you're seeing increasing pressure to normalize interest rates, even if economic conditions don't improve.
So do you think the overall, we're seeing an increase in interest rates, although the major economies, like central banks, the Federal Reserve, have not actually increased rates yet. So I guess the assumption is that all this is just in anticipation of what they expect to happen, maybe in December with the Fed and potentially with the ECB and the Bank of Japan in the near future?
Yes, some of it is anticipating what the central banks will do. However, in a broader sense, I think it's important to remember that the market sets interest rates. It's not the Fed. The Fed can influence interest rates, but at the end of the day, the market is the marginal buyer and seller of bonds. And the market sets the clearing rate for money. It's not the Fed. And on occasions in the past, particularly sometimes in the 1990s, you had occasions where the Fed wanted one thing and the market wanted something else, and the market won. So help me understand that a little bit more. So, the idea of the market setting rates, that makes sense. The market sets the price for shares of Apple and shares of Google in the same way the market would set the price for bonds. That makes sense to me. So, but if that's the case, then what's the Fed actually doing when they raise and lower rates? Mm-hmm. Yeah, most specifically, the Fed is encouraging banks to increase or decrease the amount of reserves that they hold by changing the interest rate that banks can receive. And so they can influence the money supply by encouraging banks to either make more loans or to dial down their exposure. But that's an indirect effect. And until recently, the Fed wasn't involved in the bond market directly. It wasn't. Now, obviously, they're buying lots of Treasury bonds and other assets. But prior to 2008, the Fed acted indirectly.
So really, the buying of bonds via QE was actually a more direct way of impacting bond prices than what they're doing in terms of setting interest rates right now.
Mm-hmm. That's correct, and that's why you saw various different forms of QE, such as twist, where the Fed was trying to influence the rate curve, which is something that they haven't really tried to do much in the past because they wanted to make conditions more favorable for banks or more favorable for borrowers. The Fed is getting more hands-on to try to have more direct influence in setting interest rates. However, that's not a role they've traditionally had, and it may not be a role that they have forever. The market's kind of granted them as if they're all powerful at the moment, but that's not been the case historically.
That's a fascinating idea because that's definitely not something that you hear very often because like the market has treated them as all powerful, and that's the way it's always reported. Well, the Fed is controlling rates. And what you just said, so it's okay, this is why I like understanding bonds and things at a deeper level, because like stocks, it's obviously valuations can be, there's all kinds of different perspectives as far as the best way to value a stock, and that's its own conversation. But even that seems fairly straightforward. With bonds, there's a lot of different layering that seems to go on. And so when the Fed is, so say on December 13th, 14th, when they have their meeting and everyone's expecting, I read in Barron's this weekend, was it a 68% probability that they're going to raise rates? Who knows? So if they raise rates from 0.25 to 0.5%, then that basically is only impacting how their relationship with some of these major banks works. And the assumption is that the Fed is hoping that by controlling the rates being charged to these major banks, that are then interacting with the rest of the economy, that by controlling that relationship, they can then impact the rest of the market. Is that accurate?
Yes, that's correct. By influencing the banks to say you should be making more loans or you should be making fewer loans, that will generally cause both treasuries and mortgage rates to go the direction the Fed wants. The Fed can influence direction fairly heavily, although they can't really set prices. They have influence on, they can influence things, but they really can't set the actual rate that the bonds end up at.
Right. Well, and that's, I guess, where you see, like Bank of Japan, for example, where they're saying they're targeting 0% interest rates, but they can't make that happen.
Mm-hmm.
So what is
it's the thing with their inflation targets? The central banks around the world have been trying to set higher inflation targets for years, and they pull levers, and it causes inflation to move somewhat in the direction that they want, but they can't actually get it to the destination.
Right. So tell me, and again, it gets kind of confusing too, because it can be easy to forget that the Fed technically is an independent private organization and is not a part of the federal government. And so, but then you've got treasuries. And so it can be easy to think that, well, you've got U.S. treasuries and then you've got the Fed setting rates. And it's easy to think, well, these are all coming from the same place, but they're not. So is there any relationship between what is the Fed's relationship to U.S. treasuries?
Yeah, and we like to think the Fed's independent, but clearly sometimes they haven't been.
Sure. Yeah, I mean, there's plenty of overlap, but technically they're independent, yeah.
Mm-hmm. Yeah, I don't think the Fed is like coordinating directly with the Treasury Department in terms of setting interest rates, but clearly everyone is talking to each other, and and one is not working against the other one.
Right.
They want the same general results.
And so when the Treasury is selling their bonds, I'm just trying to understand, because a lot of times, I don't have it pulled up in front of me, but like when the Fed is trying to set rates, am I understanding or remembering correctly that they're trying to get U.S. Treasury interest rates at a certain level? Is that correct?
I would say it's more that the Fed's focus is on controlling how much banks are lending. That's their primary lever. Okay. And then everything comes off of that. Okay.
Yeah, and so this is just an example for me where, like, once you get into some of these relationships, and obviously they all do connect together, but it can be really complicated for, I'll just say, the average independent investor to connect all the dots. I mean, it's obviously very possible, but it can easily get loopy quickly because what overlaps where.
Forget just average investors. Economists debate this stuff endlessly. In university, we spend much of our time debating, like, when the bank does something, how much of it is a real result and how much of it is them just talking to the market. Economists debate this endlessly.
Yeah. Well, and it shows the complexity of when markets are the size that they are, there's so many, not infinite, but seemingly endless interactions going on. It's so hard to know what the crowd's going to do. And it's just, it's remarkable. And, just reading through, the fact that central banks are having so much trouble getting the economy to do what they want it to do shows that this is way more complex and not as simple as people want it to be. And that we could easily jump this off into a whole other conversation based on that. And, I want to save that for now, but it is fascinating. Back to what we're seeing globally. So you're seeing interest rates rise, yields rising, on U.S. treasuries, but you're seeing this also in Europe and elsewhere?
In Japan as well. Their treasury was down to negative 0.4%. Now it's back to zero.
Which is what Bank of Japan is hoping for, if I remember correctly.
I believe so, yeah.
And so do you think, so obviously the central banks have been trying to boost the economy. And you mentioned earlier that either the rise in yields is people being increasingly confident that the global economy is improving, but it also could be they're just tired of waiting for the Fed. Does that sound fair?
Yeah, that's definitely true. I'm not just tired of waiting for the Fed, but tired of waiting for interest rates elsewhere. Remember that U.S. interest rates are well above in Switzerland, Europe, Japan are all zero or negative, and so there's a global lack of yield. It's not just a U.S. phenomenon.
Right. And so in a sense, one way or the other, we may not know the reason, but for one way or the other, the market's saying, hey, this has gone too far. We need that yield needs to rise. And obviously so the market is charging higher yields or asking for higher yields.
Mm-hmm. And as I stated in my article, I think a lot of the end of the move into the negative territory was driven by momentum investors, be it algorithms, be it hedge funds, people that saw that wanted to bet against kind of the wisdom was interest rates have to go up because they've reached zero. And so some smart people figured, oh, there's a lot of people betting that way, so we can make money betting the other way. But I don't think that was actual real demand of people saying, we think Swiss bonds at negative 0.2% are a great deal. It was just people trying to take advantage of catching the market off guard. And so I think a lot of the move earlier this year was artificial, and you're seeing that unwind.
Well, tell me, you mentioned Deutsche Bank earlier and how some of their problems were stemming from the fact that with yields as low as they are, and they could not be profitable with that model. But it's my understanding, and obviously I'm no expert when it comes to the banks, but I always thought, well, whatever yield the banks were paying to get access to capital, then can't they just upcharge that when they loan it out?
Yes.
But obviously, it's not that simple.
The problem is that they have large overhead. Bankers are generally well paid, and particularly if you want to be a global institutional bank on Deutsche Bank scale, you need to compensate your employees well. And so the margin they're getting is not enough to cover their expenses, particularly with all of the regulatory trouble that they've run into.
Well, I guess I'd assume that, let's say Deutsche Bank can access money at 0.5%, and their typical markup, say, is 1%. So then they loan it at 1.5%, and they can have a 1% markup regardless of how high interest rates are. So if interest rates are 0.5%, they loan at 1.5%. If the interest rates are 5%, they loan at 6%. Obviously, it isn't that. I guess it's probably more of a variable rate. Like they'll offer money at a certain percentage above, not a fixed number, but a certain percentage above where they are. Do you know how that works?
Sure. What you're talking about is net interest margin, which is the difference between what they pay for deposits and how much they can loan for. The problem is that in Europe, you're looking at net interest margins of, like you're saying, 1%, 1.5%, whereas in the U.S., you see 3% is around the U.S. average now. And you look at a lot of emerging markets, it's 5%, it's 6%. So if a bank is making 5% on its loans, as you can get in Latin America, that leaves plenty of money to pay your employees, still have profit left over. If you're in the U.S., 3% is enough to do business. You're not making a lot of money, but it's fine. But 1% is not, it doesn't cover your fees.
Okay, so, okay, so I guess because in the U.S., because it's generally accepted that rates are going to be higher in the U.S., that means banks can then loan their money, like their own capital that they have, they can loan it at higher rates. And because it's not necessarily an issue of how much it costs them to get capital, because they're getting capital from investors, not necessarily borrowing that, so they can loan it at 3% versus at Deutsche Bank. They're not necessarily borrowing capital to loan. They've got capital from investors, and they're stuck not renting, but loaning that money out at quote unquote market rates. Okay, that makes more sense. I guess I was forgetting the fact that most of these bankers, in theory, are capitalized via investors as opposed to them borrowing money also.
And the other issue that you have is just the economy is so weak in most of Europe. Who are they going to lend to that can service debt at a higher interest rate? In the U.S., you have various areas that are interesting. The automotive industry is going well now, so there's a lot of demand for loans there. The housing sector is doing well, so there's plenty of demand for both mortgages and construction loans. But you look at Europe, at least where I was living in Spain this summer, nothing's getting built. You have suburbs that are half built from 2008 that are still just sitting there.
Wow.
So who's the bank going to lend to? Incomes are flat. There's 20% unemployment, so there's not a lot of consumer activity. It's just yeah, you can get money at 0%, but who are you going to lend it to?
Right. Well, tell me this. In your travels or your evaluation, U.S. or in Europe, is your sense that economies are improving, or is it more ongoing stagnation?
I don't think the global economy is doing well. No, I think there's pockets of strength, particularly in certain emerging markets. But the U.S. is about as good as it gets in a developed market, and the U.S. is doing okay, but it's not been a robust recovery.
Tell me, what do you look at when you come to those conclusions? What helps you get there?
Mostly the standard economic data, income, unemployment, new jobs, consumer spending.
Okay. Yeah, because obviously, depending on who you ask, some people will make try to continue to make an argument that things are getting better and continuing to improve. Then, obviously a lot of people don't share that view. And my sense continues to be that things definitely, there has been improvement, but the stagnation is also very real also. But like we mentioned earlier, when you have economies the size and scope of the U.S., not to even mention the globe, then it can get really tricky to really understand what's going on. So,
I would just say quickly that I don't think the Trump campaign would have gone anywhere if people were happy with the state of the U.S. economy.
Yeah, good point. Yeah, I'd say so. Okay, so and you mentioned because the chase for yield being over, thanks to yields on bonds increasing as they have been globally, and leading to sell-offs in REITs, utilities. What do you see? What do you see in those spaces with REITs, utilities, and other typical yielding equities? Do you see those continuing to be a bad place to have your money parked?
Yeah, particularly utilities, I don't think all that attractive. And if you look at how far they've run up from 2012, there's a lot more downside potentially available. As far as REITs go, if you want exposure to them, I would start buying the higher quality ones. I know they yield less, but you want ones that aren't going to have problems rolling over their debt and aren't going to have a capital crunch if interest rates keep going up. If interest rates just kind of level off, say the Fed hikes to 1% over the next year and then leaves interest rates there, then REITs will be fine. But if they keep going up, you want to own a REIT that can withstand the pressure. If you look in like 2008, and a good number of REITs just disappeared. They went bankrupt or they sold their assets for pennies. And so if you're buying a REIT that yields 8% now, that's great if conditions stay all right. But if interest rates go back up to 6%, no bank's going to lend. No bank's going to roll over their debt. And so that's the kind of REITs that are going to get crushed if interest rates really go way back up.
Right. Well, Ian, this has been fantastic. Any parting thoughts you want to leave us with before we sign off?
Yeah, I would just say that we've been in this no interest rate, like nothing yields anything mode for so long that I think a lot of people are getting excited. They get the first sign of a sell-off, like, hey, something I'm watching is down 10%. But just look at a long-term chart before you buy it and see how far it's run up and make sure that you're not buying into a dip well before valuation becomes more favorable.
Do you? No one knows the future, but do you have some levels of concern that there could be some bigger dips coming in the next 6 to 12 months?
Yeah,
shakeups market-wise.
We've been in a very long bull market and in a very long economic recovery, and so even just the mathematical odds would suggest we're nearer to a recession than we are to, 5 more years of bull market.
Sounds great. Well, Ian, thanks again for coming on the show as always. It's great to have you.
Thank you. It's been fun.
Well, hope you enjoyed today's interview with Ian Bezek. Remember, you can get full show notes with links and other details at investorinthefamily.com. Don't forget to subscribe to that podcast at iTunes, Stitcher, or the Google Play Store. And if you want to receive my detailed summary notes sheet highlights from today's show, simply text the word family notes. That's one word, family notes, to the number 44222, or visit investorinthefamily.com and sign up, and we'll be sure to get you taken care of. This is Brian, and thanks for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.